Welcome back. Hope you're having a good morning. Well, let's welcome on the show Gurmeet Chadda, Managing Partner and CIO at Complete Circle, who joins us on the show. And we're also joined by Abneesh Roy, Executive Director at Nuvama Institutional Equities, who joins in as well. Good morning, gentlemen. Thanks so much for joining in. Well, Abneesh, let me come across to you first, because Pidilite is likely to be the stock in focus in the initial part of trade. That's because there was a margin miss and there was a volume miss as well. And as we all know, it always trades at elevated valuations. What would you do with the stock from here on, given that it's going to start on the back foot? And would you look at buying into it?
Yeah, there is a slight miss. Results came post-market. So yes, there could be slight negative reaction. We don't expect a significant correction given FY24 will see benefit of full correction in the VAM prices. Even this quarter, if you see, the miss in EBITDA is more because of the slight miss in terms of the revenue. Margins have expanded and margins are at a 7-quarter high. Going ahead, discretionary slowdown is what is impacting Pidilite, because Pidilite, if you see, the product Fevicol is used in almost everything. So the slowdown which we are seeing in the discretionary segments, essentially footwear, apparel, furniture, etc., to some extent, clearly, we are seeing the impact of that. But having said that, I think the EBITDA growth for Pidilite will be strong. Pidilite has also entered decorative paints, which we think is a step in right direction. But we don't think that Pidilite will be spending very high on advertising. It's just through the existing distribution and channel, they'll try to sell incremental paints. It will not be a very cutthroat battle with the market leaders.
Okay, since you're talking about paints, let me take that discussion forward with Gurmeet. Gurmeet, hi, good morning. Kansai Nerolac was a really strong showing. I mean, auto demand has picked up, industrial demand has come back, and this is a space that you track very closely. How are you feeling about the numbers, and as an investor, which stock would you buy in this basket?
Sonia, actually, I think it's a pleasant set of numbers. Not only because of the volume growth. I think after some 7-8 quarters of margin compression, the margin expanded, and obviously the bonus issue would also help one to in terms of the near-term segment. And I think not just decorative paints, the industrial segment, which is led by automotive, etc. Also added to it. So I think it's a positive set of numbers, but you are already at, like, let's say about 50 times, so maybe there could be a near-term reaction. I think the better segment, within that housing building materials, since the demand continues to be robust, is basically something like cables and wires, where you have some good companies available still at, relatively the valuations are always relative, maybe 30 times. Then you have some in sanitary ware, something like Cera, which is slightly more reasonable. So I would play that. Paint as a segment looks slightly expensive, so would not incrementally add to it. And also look at something which is more in the affordable housing segment, because that's something which is expanding very, very quickly. They don't compete much with banks. Banks in fact tend to buy the affordable housing portfolio as part of the PSL requirements. So something like an Home First and some of the niche players, who operate in a specific geography.
Okay, I'll come to Home First, Gurmeet, in just a bit. Good morning, good to speak with you, and good to have you with us as well, Abneesh. Good morning. Your thoughts, Abneesh, on this TCNS ABFRL deal, which the market doesn't seem to be happy at all with. TCNS was down some, I think, 20%. ABFRL was down 5-6% yesterday. Just your thoughts on both, assuming, viewers own these shares. What would you recommend?
Yeah, I think this TCNS sale has been under discussion for a long time. And of course, TCNS, if you compare the growth versus the other apparel players, clearly it has lagged. So definitely what we see is ABFRL has done multiple acquisitions. Also, it has gone into innerwear on its own organic manner. So we do see that, yes, ABFRL is a much larger company, understands retail much better. Also, in terms of portfolio, if you see, ABFRL now gets a play in the ethnic wear, especially in the mid-end. Market, of course, has been concerned that ABFRL has been doing multiple acquisitions in the last 2 years. Of course, because of COVID, a lot of the acquisitions became possible. and ABFRL has been closing the gap in its portfolio. Our sense is now we are at the fag end in terms of the M&A. In terms of the EPS dilution, yes, first year, of course, will be EPS dilutive. And in terms of the share dilution also for ABFRL, 5.7%. So we prefer ABFRL over TCNS for sure. But definitely, this has been an acquisition which has been under discussion for a long time. And we expect ABFRL to definitely scale up TCNS given its better understanding of the retail over a 2 to 3 years time frame.
Okay. Gurmeet, there is a lot of action in the primary markets as well. I mean, the largest IPO of the year, right? So far, Mankind Pharma, the listing is happening today. And it looks like a tick mark on all the boxes. It's a debt-free company, very strong growth, popular brands, large institutional, participation as well in the IPO. How are you feeling about it? And post-listing, is there scope to buy?
So I've been working associated with them for more than 10 years now, including my Citibank and Reliance Mutual Fund days. It's in a branded generic business, which is more like, if I were to compare a rural FMCG business, because they're extremely strong in the hinterland. So if you see in terms of number of prescriptions, they are the highest. Since they are more in affordable medicine, the top line wise, they are in top 4. Also, the productivity they have in terms of MR, they almost cover like 4 lakh plus doctors. So it's more like an FMCG distribution reach, affordable play. Plus, they have almost now 9 therapies, which do about 200 crores kind of a top line. The consumer health business is doing well. They are market leaders in contraceptive pills, Prega News, condoms, etc. And that also business is shipping and largely domestic company, 97, 98%. So I think should be a steady listing and the valuations are reasonable or fair, I would say. I think should be a core portfolio stock. But this is not a stock where you expect, very high returns. Could be something to do with listing, which could happen today, but a very steady counter to look at more for the long term.
Okay, all right, Gurmeet, just hang on. Going back to Abneesh for a couple of questions. Abneesh, yesterday the big mover was Marico. Solid set of numbers. The street liked it. What do you do with the stock from here on? What's the rating? What's the target price out there?
Yeah, it was a overall good set of numbers with 5% volume growth. The margin expansion, I think, was the key surprise. In FY24, Marico's Saffola Foods portfolio also will see a decent growth with 850 crore revenue target. This quarter, Saffola edible oils was quite weak, and this we also saw for Adani Wilmar, for example. There has been, of course, in-home consumption in the base quarters in the COVID era, and also price cuts have happened. My sense is further price cuts in edible oil is something which government is also driving. So overall, we like Marico from a longer-term perspective, but given the move which has happened yesterday, I think near-term upside will be limited. In fact, we prefer Britannia over Marico, given the kind of numbers which Britannia reported, 12% PAT growth, 45% EBITDA growth, and wheat also for next year, if you see, the crop versus initial expectation has been much better. 30-40% higher government collection has been there. So we prefer Britannia over Marico at current levels. But yeah, Marico's margin performance was quite decent.
Okay, but on Britannia, what kind of valuation headroom does it have now? Because, that is the big concern, right? That there is growth, of course, but it doesn't come with any valuation headroom. Your thoughts?
So 3 things, Sonia, will happen. One, of course, Street was a bit disappointed with the 2 to 3% kind of volume growth which they reported. But customer doesn't buy 100 gram or 200 gram of biscuit. He buys packs. So packs was 12% growth. Now what will happen is in FY24, Britannia will give back the grammage cuts which they have done. Now they'll give back the grammage back to customer. So volume growth will revert to a much better number. Of course, with wheat also crop being better than expectation, my sense is the EBITDA margin and gross margin good performance will sustain. If you see in terms of croissant, dairy and rusk and cake also, they have been doing well. So currently, if I see, yes, stock is now out almost 40 times FY25. In fact, we upgraded our numbers by 3 to 5% EPS for next 2 years. But Go Airways going away as a concern, that is a positive because that was seen as a concern. So we don't see any indirect exposure to Go Airlines, but we continue to monitor that. But yeah, on the face of it, it seems that it's a positive.
Gurmeet, just a few stocks your way. Now, one is earnings. Both UPL and Aarti Industries. We spoke with our UPL yesterday. Aarti will join us today on the show. Numbers look pretty subdued, and the guidance, even though it's lower than what they've done in UPL's case than FY23, it still looks a little aggressive given the environment. Your thoughts, if you have any. Second is Chola Finance. It's done remarkably well, now trading at 7 times book, FY24 book. So are you comfortable paying that much? And then PSU banks, if you will, where generally 3-4 banks which have reported, and we have the management of Canada joining us a little later, there is some margin pressure. Go on.
So I'll start with the banks, Prashant, since that's the recent one. I think we've been sticking to SBI for some time. Tactically, Bank of Baroda, because for us SBI is a more structural play. I think because if you look at the credit cost metrics, you look at the restructured book, look at the way they're in fact, some of the metrics on asset quality are as good as some of the private sector banks, and there is valuation comfort. There was a good price correction due to the Adani episode. So that remains our pick. Others we are avoiding. In fact, there are better banks in small private sector banks where there is valuation comfort, and there could be some re-rating if we have better 2-3 quarters. IDFC First we have seen is doing a very, very good job. CASA is almost now 50%. I saw an NII growth of 35%, and the wholesale book continues to degrow. So their legacy book continues to shrink, which is very healthy. So if they can report another 2-3 good quarters, possibly some re-rating more can happen. Federal Bank also, if you see there's a cyclical agri book slippage which happens this time. Otherwise, that also is like 1.2 book value. So that's on the banking side. On chemicals, my sense is you have to maybe wait for another quarter. There is another one more quarter before the repricing sets in. And there is a bit of a base effect. UPL has valuation comfort. It's always been cheap for reasons other than financial performance also. So you got to be very selective here. I would start more now on agrochemicals because the rural economy will see some push by the government. There are 6-7 state elections as far as the market is concerned. So that's something we'll be more selective. I'm more comfortable right now with PI, although valuations have been on the higher side. There's some of the fluorination themes where the demand outlook is strong.
Okay, and 7 times for Chola, fair? Or
I think so. NBFC, there's some catch up, Prashant. I think after good numbers, both for Bajaj, if you see, the banks went up, and players like a Bajaj Finance, bit of Poonawalla, Fincorp, Chola. I think now you should review them more on earnings. I think because I'm not saying price book multiple should be completely ignored. It's on the high side, but the asset quality test has stood the test even in times like COVID. And they are more like, play on how's the consumer demand shaping up. So Chola more for vehicle, Bajaj more on, the personal consumption side. So earning, the P multiple also should be taken into account. But yes, valuations are rich.
All right. Gentlemen, let me just thank Abneesh. Abneesh, thank you for your thoughts. And Gurmeet, just stay on for a tad bit. We'll need to take a quick break. On the other side of the break, we have our technical experts coming through, Mitesh Thakkar, Sudarshan